Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome back to part 2 of class 2. In this part, the focus will be on the factors that play a role to change the determination basically of exchange rate. So any currency basically go up and down in value based of course on many factors, not one. So it's a bit complicated. There are other factors, but now we will focus on the main ones. Number one, inflation. Number two, interest rate. Number three, income level, how much money you earn, you make in this country or in this city or in this other country. And then government control. Do government try to intervene and play a role in determining the price of a currency, or they don't care, they leave it up to basically supply and demand? And finally, we will discuss expectations. So psychology plays a big part in finance economics, right? So if you believe Malaysia is doing better nowadays due to some reason, then you might invest in buying their currency. Why? Because you believe it will appreciate, it will become stronger. So 20 years back, if you believe China will be a strong economy and you invested in purchasing Chinese yuan, you might have more money in ringgits right now. Okay, so all of these factors will play a role. Let's take a look at each one of them. Sorry, the slide. Okay, first, inflation rate. Okay, so increase in US inflation. What does inflation mean? Prices goes up. So same basket of goods, some food, for transportation, the same money you need today to do a package of things, let's say, maybe tomorrow you need more. If you need more, we say there is inflation, prices are going up. What about other countries? Maybe you say all countries are the same. In all countries, prices are going up, in which you are right somehow. However, the degree in which they are changing, it's not the same. You might say inflation is not good here in Malaysia, right? Inflation is a bit high. But you go to other countries in which they have war, you notice that inflation is at least triple or 10 times the amount of inflation here. So inflation is always there, but how bad it is will play a role in determining the price of your currency. So increase in US inflation leads to increase in US demand for foreign goods. So when prices of American goods go up, right, you start buying from outside because you have money and prices are going up. And then an increase in the exchange rate. So when you want to buy foreign currency, you need to buy that currency first. So when you buy from UK, usually you pay in British pound. You buy from Malaysia, you buy in ringgit. So when you want foreign goods, first you need to exchange your currency for their currency. So when we all want to buy foreign currency, what happens? Basically, foreign currency demand increases and price increases against our currency. Next, let's move to interest rate. Interest rate is also very important in determining the price of a currency. Why is that? Okay, so what's interest rate? You deposit some money in my bank, I give you interest. So let's say 5%. What if my friend in another country offered you 7%? You go there. Another country offered you 10, you go there. So money, we say, travels from one country to another seeking opportunity, investment, profit, higher profit. So increase in US rates leads to increase in demand for US. So if US increased interest rate, all of you want to deposit in US banks to get high interest. However, to deposit in US banks, you need to deposit in USD. So first you need to buy USD. Exchange your Malaysian ringgits for USD first. So demand for USD increases. Everyone wants USD. Why? Because we want higher interest rate and a decrease in demand for foreign deposits. So what about our currency? The opposite, because we want USD, leading to an increase in demand for dollar and an increased exchange rate for the dollar, of course. Impact of rising US interest rate on the equilibrium value. However, one here may take a moment and think, what if I invest in a country in which interest rate is 20%? Perfect. Highest on earth. So every year I make 20% profits, which is great. However, which is the case sometimes in Turkey. So Turkey, inflation is very high. However, interest is high. So I want to take my Malaysian ringgit, convert it to Turkish lira, invest it in Turkey, make 20% per year, convert it back to ringgit, and bring it home with 20% profit. However, in theory, you're right. When you do it, you notice that the price of Turkish lira at the beginning of your transaction and at the end of your transaction depreciated maybe 15%. So the Turkish lira is worth less ringgits now, 15% less. However, you made profits 20%. So what's your real profit in Malaysian ringgits here? It's 20 minus 15, only 5. So at the end of the day, you tell me the story, I tell you, so why didn't you invest it here? It's the same, okay? So one may recognize that there is a big difference between nominal rate, what we see, 20%, this is nominal, and real interest rate. When we focus on real interest rate, we must remember that we must consider inflation, okay? Let's continue with income levels. So increase in US income levels. If our salaries doubled, okay, immediately our salaries doubled, what happens? It will increase demand for foreign goods, right? If your salary doubles right now, you start buying, luxurious stuff, you try foreign goods, you buy better quality of everything at home. Increased demand for foreign currency relative to the dollar, and an increase in the exchange rate for the foreign currency. So this is what usually happens. When income increases, people start to spend more, so they start look for luxurious goods. So importing increases and it has an effect on the currency. Let's move to government control. What about government? Okay, so after our discussion, some people might come to me and say, I went to Saudi a few years ago. One Saudi Riyal, or let's say 1 USD was equal to 3.70 cents Saudi Riyal. I went back this year, it's the same. And you are right. So how did it remain exactly the same? It's surprising, right? It doesn't make sense. It's not logical. How come the economy is not changing? Everything is the same. Well, whenever you see the price not changing, you should remember that sometimes governments intervene to make it stable. Why? Why would governments do that? Because they don't want their currency to be depreciating. Why? Because it will affect their economy. So there are many theories, okay? So you cannot say this is right, this is wrong. So in finance or in economy, we have different theories. Some people believe it's better in some circumstances to do this. Sometimes it's the opposite. So some countries where the economy is very developed and strong, they leave it up to to power of supply and demand. Whereby in other countries where the change might cause big harm to the economy, they try to intervene. So how do you intervene as a government? They basically observe the loss. So they try to observe the loss if there is a loss. Why? Because they believe this loss will be worth less than what would happen if the price changes. So, for example, in Saudi, they believe if it depreciated, for example, the 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 price for petrol would be very bad, which will affect the economy because their economy is solely based on petrol production. So, regardless of the reasons, some governments control their currency, so they sell gold, they sell USD, they use up their reserves. They have reserves. If they found the currency is not doing well, they put some reserves and help. So, how do they control it? They impose foreign exchange barriers. In some countries, it's not easy to import and export. It's impossible. You need so many files to the government and to prove your why. For example, if in my country, if you want to import something in which we produce the same thing at home, most likely you will not be able to do it. Why? Because we believe, for example, if you import clothes from Turkey, our producers of clothes will not be able to sell their goods, which will affect the economy. So the government prohibits us from importing. They say, support your local producers, buy from them. Imposing foreign trade barriers. Similarly, foreign exchange barriers, basically, it's about the exchange. Trade is about the trade. So in Syria also, if you want to exchange for USD, it's not easy at all. It's not like here because it will affect the price of the Syrian lira, and they have a circumstance in which they have war. They believe someone might play with the price and affect the economy. So there is many barriers. Similarly with trade, intervening in foreign exchange markets, so they start to do something in other markets to affect the price at home, affecting macro variables such as inflation, interest rate, and income levels. So some governments play with these factors just to fix or increase or decrease based on what they want to do, based on the policy and what they want to do with the exchange rate. Next, we move to future expectations. So, if you believe that one company will be doing better tomorrow, and everyone believes the same as you, the price of this company will increase. Okay, and vice versa. When Steve Jobs died, people were sad, they were pessimistic about Apple future, so the price decreased a little bit. Same with currencies. If you believe China is doing well and will do better in the future, you invest in buying their currency and keep it in your safe for a few years. And any other country similar to China. So what you believe might be different from what I believe. Okay, so some people might believe that developed countries will be doing better and better, so they buy their currency. Some others believe, so psychology also plays a big part here. Some others, they believe the opposite. They believe developed countries are more organized, they're stable, they're doing better, so they invest in their currencies. Same with any different good. So let's go back to the slide. Impact of favorable expectations. If investors expect interest rates in one country to rise, they may invest in that country, leading to a rise in the demand for foreign exchange, for foreign currency, and an increase in the exchange rate accordingly. When demand increase, price increase. Impact of unfavorable expectations. Speculators can place downward pressure. So if, let's say, Malaysian economy is not doing well, okay, and people can make it even worse if they start selling ringgit, so they increase the pressure, right? Malaysian ringgit is suffering already, but we make it worse by selling our reserve from ringgit. We believe it will be worse tomorrow, so we start selling, all of us, so supply increase more and more, and price decrease more and more, sink down. Impact of signals on currency speculations. So speculators may overreact to signals, causing currency to be temporarily overvalued or undervalued. To be clear about speculators, what do we mean by speculators? So in every economy, there are people who need USD. Why? Because they want to import something from US. Some country they need ringgit. Why? They import crude palm oil from Malaysia. However, some people they don't need USD. They don't buy anything from US or ringgit. They don't buy anything from ringgit. But we call them speculators. They just buy and sell seeking profits. Okay? So they don't care about, they don't actually need it. They just want to play with the chance that they believe based on expectation it might go up or down. So, how does a currency react to these changes? Okay, does it change immediately, or is it one factor affecting? No, it's a combination of all together. So sometimes bad inflation, low interest rate, many factors contribute and make it worse. Sometimes something is bad, something is good, so it's like a balance. So some factors place upward pressure while others place the opposite, downward pressure. So you can see here that in this graph we see trade related factors, we see financial factors. They're all contributing to US demand, for example, inflation differential, US demand for foreign goods, and then leading to US demand for the foreign currency. So all of these, you see, you follow the chart, all of these, each will play different role. Some are playing positive role, upward pressure, some the opposite, downward. So these opposing powers will, based on their power, basically determine the price at a certain point in time. Tomorrow, this power balance will change, price will change again. Is it only what we discussed? No, sometimes there are other minor factors, but what we discussed here basically compose the major parts in general. Okay, let's move to the next slide and see the influence of factors across multiple currency markets. So common for European currencies to move in the same direction against the dollar. So usually geographical areas and unions like European unions play a role in which it becomes all currencies usually follow one another. Why? Because the high level of interaction contribute to that, of course. Influence of liquidity on exchange rate adjustment. So what does liquidity mean? Same with businesses. Liquidity means cash. So with currencies, they also say how liquid it is. If a currency spot market is liquid, then its exchange rate will not be highly sensitive to a single large purchase or sale. So we say about USD, because everyone is using USD, it's not easy to manipulate the USD. So even if you play with 1 billion USD, you're not really gonna affect the market much, maybe a few minutes, that's it. Why? Because there is high level of exchange between people when it comes to USD. However, you go to Cambodia, you play with their currencies with a billion ringgit, and you notice the currency might actually change up or down. Why? Because very small economy. And that's why we notice that the majority of these countries trying to protect and put some restrictions on their currency are not very strong economies. So let's read this example. Movements in cross-exchange rates. If currencies A and B move in the same direction, there is no change in the cross-exchange rate. Okay? Sorry. Sorry, just a second. Okay, so if two currencies move in the same direction, of course, this currency to that currency, there will not be much change. However, when currency A appreciates against the dollar by a greater degree than B, then currency A will appreciate against B. Okay, so let's take an example. Malaysian ringgit and let's say Singaporean dollar, our neighbors. So let's say if both of us go up in the same degree, there is no difference in our exchange rate. However, if Singaporean dollar appreciates against dollar more than we appreciated, so we both appreciated, but Singaporean dollar appreciated more faster than us, then Singaporean dollar will appreciate against our currency. However, when currency A appreciates against dollar, while currency B is unchanged against the dollar, currency A appreciates against currency B by the same degree as it appreciates against the dollar. So, in the last section, we're saying Singaporean dollar appreciated, however, ringgit stayed the same against dollar. How much is the difference? What's the new price between Singaporean dollar and ringgit? Same percentage change with USD. Why? Because we remained constant. We didn't move. Okay, so changes are affected in the same way as types of forces explained earlier for those that affect demand and supply conditions. So these factors are something really important. I need you to take some time to go back to them, try to read them, and take examples, create examples in your head and try to go with the example. It should be logical. It should make sense to you. You should be able to convince yourself first, then someone else doesn't know about it. So you need to come up with an example which is logical and try to proceed with the 5 factors. Understand all of them. If you have any questions, please, you can write it down and direct it to me during our Q&A session. So changes are affected in the same way as types of forces explained earlier for those that affect demand and supply. So again, we go back to demand and supply. When demand increase, more people want it, of course, price increase, and vice versa. Let's say some news came about Toyota, bad news, just example. So no one wants Toyota anymore, demand decrease because of some safety issue. Not only this, what makes it worse? Supply increase. All of us now want to sell our Toyota. Why? Because we believe it's not good. So demand decrease and supply also decreased, leading the increased, sorry, leading the price to worsen even more. So you must understand that the relationship between supply and demand is not the same to price, right? They react in opposite way. Example of how forces affect the cross exchange rate. So what you can see here is the value of British pound, Swiss franc in terms of USD. So year 1 until 5, in year 1 you notice that the value of British pound is $1.6. However, Swiss francs 80 cents. In year 2, price change, okay? British pound become 1.68, so basically appreciates 5%, whereby franc also appreciates 5%, becomes 84 cents. Then year 3, British pound appreciated further, 10%. How about Swiss franc? Also appreciated, only 5%, same with the previous year. Now, next year, year 4, the opposite. Also, British pound appreciated, but in a lower degree, 5%, whereby now Swiss franc appreciated 10% fast in year 4. So year 4, Swiss franc, Swiss economy doing better maybe. Last year, we notice surprisingly British pound depreciated against USD. So it went back down actually. Not to as it was in 4 years ago, but it started to depreciate. However, Swiss franc continued to appreciate, but only 5%. So how was it easy for me to tell this story? Because I'm observing the annual change. I'm not looking at the numbers. When you look at 160, 168, then 184, it's not easy to say 5%, 6%. It's very complicated. But when you look at percentage annual change, it's easy for you to tell the story, especially if you plot it on Excel. It becomes like linear, right? So now what I need you to do here is I gave you two values. One value, Swiss franc to USD. Then I gave you British pound to USD. Now I'm asking you, based on these two values, to calculate cross value. Cross, right? You need to cross lines. How? By computing Swiss franc to British pound. And this can be very confusing. Franc to franc to pound or pound to Swiss. What do you want, right? So again, you need to use your logic, and after you get the answer, it should make sense to you, right? So based on what we know, for example, British pound is more expensive than Swiss franc, right? Because one British pound is about 1.60, double the amount of Swiss franc to dollars. So the answer, if you put numerator and denominator in the wrong way, the answer will be wrong. So the best way to make sure our answer is correct is to make sense. It must be logical. It cannot be 10. It cannot be 0.5, right? Because here, cross rate of pound in Swiss franc. So I'm asking you, what's the pound in Swiss franc terms? Okay? So you tell me 2, meaning you need 2 francs to buy 1 British pound. So based on this, you basically divide the first currency by the second. So if you say it like this, to memorize, cross rate of pound in SF, you divide the value of pound in USD divided by the value of franc in USD. So you follow the same order. If you forget, maybe you try to remember this. So based on this, we get the value of Swiss franc to British or the opposite. Next slide. Capitalizing on expected exchange rate movements. Institutional speculation based on expected appreciation. When financial institutions believe, so banks, other institutions believe that a currency is valued lower than it should be. So let's say I look at everything, let's say I am a financial advisor and I find that Japanese yen should be worth more. Why? Based on the performance of Japanese companies, Japanese government, etc. Many reasons in my head. So I believe Japanese yen should be worth more, but it's not. So what happens here? So when financial institutions believe that a currency is valued lower than it should be in the foreign exchange market, they may invest in that currency before it appreciates. So I will take the chance and buy before others realize what I realized. Okay. Institutional speculation is based on expected depreciation. What about the opposite scenario? If financial institutions believe that a currency is valued higher than it should be, let's say I look at the Thai economy and I find the Thai is very expensive. I don't understand why. Based on the economy, tourism, other factors, I believe Thai should be worse than it is actually on the market is. So what I do, let's read together. Basically, I do the opposite to what I did in the previous case. So if financial institutions believe that a currency is valued higher than it should be, they may borrow funds in that currency and convert it to their local currency now, before the currency's values decline. So what would I do? I would borrow from Thailand and convert it to ringgit. Why? Because after a year, I believe that Thai baht will basically depreciate against ringgit, so I pay less in ringgit terms. Okay. So speculation also can happen by individuals. Of course, these individuals can be same as me and you. We can do it with few thousands, hundreds. Some rich people might do it with millions, right? So if me and you believe yen would appreciate, we can buy yen today and wait few months, see how it goes, then sell it, then invest in different currencies. So anyone can basically do that. Let's discuss carry trade in the next slide. What's the carry trade? Where investors attempt to capitalize on the differential in interest rate between two countries. Okay, so impact of appreciation. So now we focus on interest rate. Impact of appreciation in the investment currency. Increased trade volume can have a major influence on exchange rate movements. So the impact of appreciation in the investment currency, what is it? Increased trade volume can have a major influence. So if everyone wants to buy ringgit, suddenly all over the world, maybe it sounds good to you from your perspective. From others, maybe it can be disastrous, right? Risk of the carry trade, so exchange rates may move opposite to what the investors expect, of course. Same with any other industry. You believe coffee beans price will go up, so you buy today and wait. However, maybe you're wrong and it's not gonna happen, and the opposite might happen, of course. So carry trade is where investors attempt to capitalize on the differential in interest rate between two countries. So interest rate is higher in Indonesia than Malaysia, so why would I invest in Malaysian banks? I better convert my money to Indonesian money, invest in Indonesian banks, earn high interest, and convert the money back at the end of the period. In the last slide, you see the summary. So basically, we discussed exchange movements. They are commonly measured by the percentage change. So I don't want you to tell me yesterday USD to ringgit was 4.10, today 4.12. If I'm your boss, if you're working in a company where we need to focus on this, you usually report to me in basically percentage. You tell me it increased 2%. What shall we do? Easy for me to understand. MNCs closely monitor exchange rate. So now let's go back to MNCs. Why are we discussing this? Because nowadays McDonald's from US operates all over the world, Starbucks, same, BMW, so we have MNCs, multinational companies. These companies operate everywhere. So all the currencies in the world, when they change, it matters to them. Prices affected, everything, profits. And don't forget that they have a parent company. McDonald's is from US. So at the end of the day, you need to report profits in US. So you need to know about the changes in the relationship between your currency and where you're operating in Malaysia, Indonesia, all over the world. So they closely monitor exchange rate movements over the period in which they have cash flows denominated in the foreign currencies of concern. The equilibrium exchange rate between two currencies at any time is based on demand and supply. Same with anything in the world. You want something, you want it bad, you demand more, right? More people want it. If no one wants it, supply increase, people really don't want it because it's available and it's not unique to them anymore. So these two powers, these two will always basically determine the price at a certain point. Thank you very much for listening. Please write down your questions on a piece of paper. Don't forget to mention the slide number. See you later, inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.